Welcome back to Finance Theory, the channel where we break down how money really works, so you stop being the one it works against. Today's topic is one that affects every single person watching, whether you're in the United States, the United Kingdom, Canada, or Russia. It's about something sitting quietly in your phone right now, your savings account. You opened it because you wanted to be responsible. You deposit money regularly. You feel good about it. And why wouldn't you? Your bank practically congratulates you every time you do it. But here's the question Finance Theory is asking today. Who is really winning in this arrangement? You or your bank? Because while you're celebrating a few cents in interest, your bank is turning your deposits into one of the most profitable business models ever invented. Stay with us, because by the end of this video, you will never look at your savings account the same way again. Section 1. The basic mechanic. Your money is not sitting still. Let's start with the truth. Banks don't put in their advertisements. When you deposit money into a savings account, that money does not sit in a vault with your name on it. The moment your deposit lands, the bank puts it to work immediately. Each time you make a deposit, your bank essentially borrows that money from your account and lends it out to other borrowers, whether it's an auto loan, a home loan, a personal loan, or credit. My bank tracker, and they charge those borrowers a much higher interest rate than they ever pay you. Here's a real simple example. Assume you deposit $1,000 into a savings account paying 1% interest. Your interest payment for the year is $10. The bank then lends your $1,000 to a business at 5%, earning $50 in interest income. After paying around $30 in operating expenses, staff, property, insurance, that leaves $20. They pay you $10 as interest and keep the other $10 as pure profit. Mike Cody now multiplied that by tens of millions of customers across the US, UK, Canada, and Russia, and you begin to understand the extraordinary scale of what is quietly happening every single day. Here at Finance Theory, we call this the silent swap. Your money goes in, their profit comes out. And most people never notice. The wider the difference between interest rates, the more profit a bank makes. A bank may offer a deposit interest rate as low as 0.06%, while setting an 18% rate on one of their credit cards. My bank tracker, that gap built entirely on your deposit, is the foundation of modern banking profit. Section 2. The number banks hope you never Google in the banking world. This gap has a technical name. The net interest margin, or NIM. This is the single most important profitability number in banking, and most ordinary savers have never heard of it. Net interest margin is the spread between the interest a bank earns on loans and the interest it pays depositors. In plain terms, it is the profit a bank makes on every dollar of interest-earning assets after paying depositors. Truthify. Let's put real numbers to it. If a bank earns 5% on loans and pays 1.5% on deposits, its NIM is roughly 3.5%. The U.S. banking industry average NIM in Q4 2025 was 3.39%, the highest since 2019. Truth EFI, that is the industry-wide gap between what banks earn and what they pay you, and it has been growing, not shrinking. Throughout 2024 and into 2025, banks benefited from increasing asset yields as interest rates on loans rose. This trend accelerated in early 2025 as banks saw decreasing funding costs, primarily through lowering the interest rates paid to depositors. St. Louis Fed, read that again carefully. Loan rates went up. Rates paid to you went down. Banks moved in both directions simultaneously and always in their own favor. This is exactly the kind of thing Finance Theory exists to explain, because this information is public. It's in plain sight, and yet most people never connect the dots. You may have noticed your savings account pays 0.01 to 0.50%, even when your bank is reporting record earnings. That gap is the spread your bank keeps. It's not a secret. It's in the public data. Truthify, most people just never look. Section 3. The fee machine running alongside your account, but profiting from the interest spread is only the first engine. Banks have built a second, equally powerful profit machine, sitting right on top of your account fees. Overdraft fees, ATM fees, credit card penalty fees, minimum account requirement fees, teller fees, loan or account application fees, and early withdrawal fees are just a few examples of how a few dollars here and a few dollars there bring in major earnings for banks. My bank tracker in the United States, overdraft fees average between $25 and $35 per transaction. In the United Kingdom, regulators have cracked down on unarranged overdraft, charges that once reached the equivalent of 80% APR, charges that disproportionately hit the people least able to afford them. In Canada, monthly maintenance fees are standard on most basic accounts. And across Russia, Currency conversion margins and service charges quietly erode savings held in foreign-denominated accounts. None of these fees appear in the headline offer. None of them show up in the bold text of the advertisement that got you to open the account in the first place, depending on your relationship with your bank. It's important to know exactly how you're contributing to your financial institution's bottom line. Yahoo Finance. And here's the uncomfortable truth that finance theory wants you to sit with. You are almost certainly contributing more than you realize. Section 4. The psychology behind good savings now. Here's where it gets really fascinating, because banks don't just profit from mechanics. They profit from psychology. The word savings carries enormous emotional weight in every culture. In the US, it signals the American virtue of In the UK, it echoes the post-war culture of thrift. In Canada, it's tied to financial prudence. In Russia, where economic uncertainty has historically been acute, a savings account feels like genuine security. Banks know this, and they use it. When your bank calls it a savings account, it wraps your money in the language of virtue and responsibility. You feel like you're doing the right thing? And compared to spending everything, you are. But good is a relative term, and banks are experts at setting the bar just low enough that you never question it. Banks raise or lower their interest rates on savings accounts based on the amount of interest they've been able to charge borrowers, the prime interest rate in their country, and how aggressive they want to be in pursuing new account holders. Mikey, Cody. Notice what is not on that list. Your financial well-being. The rate they offered you is a calculated business decision, the minimum required to keep you from walking out the door. And because most people never switch accounts, banks use their market power to hold down the returns they offer depositors, keeping their own costs down while adjusting loan rates upward when interest rates rise. Federal Reserve Bank of Richmond. That's not a conspiracy. That's a strategy, and it works extraordinarily well. Section 5. Beyond loans. The full picture of what banks do with your money. Let's go one level deeper, because your deposit isn't just funding someone else's mortgage. Banks also invest deposits in safe investments such as treasury bonds, lending money to governments, which then pay interest back to the bank. They invest in government securities, including treasury bonds, notes, and bills, safe low-yield instruments used to manage risk and meet regulatory requirements. Some banks invest in corporate bonds or equities, though this is typically limited and regulated. Bankrate, your savings account, is functioning as a low-cost investment fund for the bank, one you never receive a prospectus for, one whose returns you will never fully see. Banks also earn fees for customer services, loan servicing, and the sales of other financial products like insurance and mutual funds. Connecticut, DMV, every product they cross, sell you the credit card, the insurance policy. The investment product is another revenue stream built on the foundation of the trust your deposit relationship created. Your savings account is the door. Everything else they sell you is what's behind it. Section 6. What finance theory says you should do now? The most important section? What can you actually do with this knowledge? Number 1. Compare rates aggressively and regularly. Banks can and do compete with each other to attract new savers. It is absolutely worthwhile to regularly check interest rates at competing banks. Mike, Cody, online banks and challenger banks in the US, UK, and Canada routinely offer rates far above the traditional high street institutions. The average savings account earns just 0.39% according to the FDI, while the best high-yield savings accounts offer APs of up to 5.00%. Fortune over 5 or 10 years. That difference is thousands of dollars, or pounds, in your pocket, not your bank's. Number 2, look seriously at credit unions. Credit unions are not-for-profit organizations that return profits to their members in the form of lower loan interest rates, higher rates on deposit accounts, and reduced fees. Yahoo Finance, they operate across all 4 countries we're speaking to today, and they fundamentally flip the profit model in your direction. Number 3, know your deposit protections. In the UK, up to £85,000 is protected per eligible person per bank. In the US, FDIC insurance covers up to $250,000 per depositor. Mike, Cody in Canada, CDIC covers up to CAD $100,000 per category. In Russia, the DIA protects deposits up to 1.4 million rubles. Knowing this means you can spread money across institutions, chasing better rates without taking on extra risk. Number 4, read the spread, not just the rate. When any bank advertises a savings rate, ask yourself, what are they currently charging borrowers? The gap between those two numbers is the profit they are extracting from you every single day. The wider it is, the harder you should be looking for alternatives. The finance theory takeaway: banks are not villains. They provide a real and necessary service safeguarding money, enabling borrowing, and powering economies. But they are, first and foremost, for-profit businesses built on a very specific model. At the end of every year, a bank pays some or all of its profits to its shareholders in the form of dividends. Connecticut DMV, those shareholders are not you, unless you make deliberate choices to change that. Your savings account is not simply a safe place for your money. It is raw material that your bank processes into profit every single day, quietly, efficiently, and with your full consent. Here at Finance Theory, our job is to make sure that consent is informed. So the next time your bank sends you that cheerful notification, "Great job, your savings are growing," pause for just a moment and ask yourself, compared to whose? Do your research. Compare your options. Make your money work as hard as your bank does. And if this video helped you see something you didn't see before, share it with someone who needs to. That's what Finance Theory is here for.